Alibaba is possibly one of the most undervalued companies in the stock market today in terms of large market cap companies. Now, this entirely depends on how you look at it. Those who go off the 5-year chart would say this is a terrible business. And the 5-year chart is indeed one ugly mother, you know what. It's a monstrosity. However, what the company generates for its current share price makes you wonder what is going on with this valuation. Why is the stock beaten up so much? We'll dive into the financials and some of the other little X factors and see if we can't come to some kind of a conclusion about Alibaba. First off, the revenue has certainly not accelerated in recent years, okay? 2023 versus the trailing 12 months, it's sort of flat, to be honest. And the growth from 2022 to 2023, not really all that impressive. So we have what I would call a pretty big deceleration in the top line growth of the business. Now, Peter Lynch says that over a long period of time, that a company's share price will correlate with its earnings. So let's take a look at cash flow and see how that might be going. The free cash flow of Alibaba, and by the way, these numbers from the data feed, these are in Chinese yuan, not in US dollars. So just keep that in mind. So it looks like, again, free cash flow hit a bit of a peak in 2020 and has since then kind of flatlined and not really gone much of anywhere at all. A lot of investors prefer to see growing free cash flow or, growing net income, some type of growth in some type of a bottom line number that tells them this business is doing better and better over time. And the free cash flow with Alibaba looks like it's stagnating a little bit recently. Alibaba pays a dividend. This is a relatively new development. I actually recently received a special dividend they decided to pay out. I guess they had some extra cash burning a hole in their pocket and wanted to reward shareholders. Now, the dividend isn't a huge out of this world yield, but I think it is sort of something the management is trying to use to return some value to shareholders in the form of just direct cash and maybe get some stability in the share price. Now, they also do a lot of buybacks, and the buyback plus a dividend is getting us to a total yield of 5.67% over the last 12 months, which is pretty decent. It's certainly more than most stocks yield, but a lot of people make the argument that, hey, you're just exit liquidity. The buybacks don't necessarily benefit you if you hold ADRs, and the dividend is a pittance compared to what you have at risk. Now, I think maybe the dividend, as since it's direct cash coming back to shareholders, is somewhat meant to kind of counter that idea about Alibaba that you don't really own a piece of the business or the cash flow or whatever. Now, the other thing that's interesting is, who else has bought Alibaba previously? These two dapper gentlemen, Michael Burry and Charlie Munger, I'll let you sort out which is which. They both, at different points, bought Alibaba. Charlie, I believe, towards the end, he did pass away last year, unfortunately. He did, at one point, say something about regretting the purchase, and I believe it was due to overpaying. I think he paid something like $200 or so per share, which is like 3x today's price almost. So I can understand why maybe he felt a little bit burned by where it went after that. Burry got in a lot more recently. I think it was in the 13F from either Q4 of 23 or Q1 of 24. And with him, it's interesting because he's the guy, of course, who sort of called it and made out like a bandit on the great collapse back in like 07, 08 on the real estate market and some of the practices that were going on then. He wanted to bet against it. He did. There was a movie. You can go watch it if you want. All that being said, I think it would be pretty. I think neither of these guys, regardless of what reason they got in or how they felt about it after, wouldn't have done so if they felt that it was that we were just exit liquidity, that there was an imminent danger of some kind of a rug pull from Alibaba or from the government over in China. So that's an interesting point. I can't get around this when people tell me that it's just exit liquidity or that the shares are not of any actual value. But I could be wrong for sure. These guys are not infallible just because they're super investors. But back to Peter Lynch's thing of the earnings and the share price will correlate. Remember I said that with regards to the free cash flow, they had higher levels back in 2019 and 2020. Well, this is the case for their earnings per share as well. And they have not yet gotten back to those levels. However, it's projected that for fiscal year 2024, that they will be above those levels again for the first time in a while, which could be a positive catalyst should it happen for the share price because of that aforementioned correlation. Now, sometimes it's a delayed correlation and sometimes it's an over or under reaction, right? Like the earnings could underperform a little bit on expectations and the stock crashes hugely disproportionately. Or it could be the situation where the earnings go up massively and the stock only goes up a little, or the earnings only go up a little and the stock goes up tremendously. Any of these things can happen, but it could be, and maybe this is why Michael Burry recently got in. Maybe he sees the tea leaves that, hey, this company is projected to put out earnings that are above some of their older, better results for the first time in a while. This could result in a major run-up in the stock. And maybe he thinks US stocks aren't going to do so well, especially tech, and that maybe this is the better play for now. He might not be in the stock in a year, 2 years, 5 years time. Maybe he sees this playing out sooner. Unfortunately, the 13F doesn't give us an insight into the inner workings of his mind, only what he bought and sold. But I could definitely see that point where we're expecting a dramatic difference in the earnings compared to the last couple years and back above some previous better years. So that could be definitely the catalyst that we may be looking for. When you combine that with their buybacks they've done, plus the dividends that they now pay out, people might start to see this as a much more attractive thing. And if there was a big surge in buying pressure, yeah, we could definitely see a run up. Now, maybe it wouldn't be back into the 300s. Maybe it would only be into the, maybe the lower mid 100s. Who knows? Analysts see it being on the high end 135 in the next 12 months, which would be low to mid 100s, so more in line with that. And I think they would have to definitely do quite well on earnings to get to that point. That low target of 85 kind of, it makes sense. Like maybe they don't hit the expectations that people are thinking with regards to their earnings. But either way, I do think pretty much these valuations from the analysts, they make sense to me based on the recent performance of the company and to some extent maybe a bit of a China discount, right? Because there is some sort of geopolitical risk and so forth, and ownership structure issues potentially with the ADR. So I can kind of wrap my head around where some of these analyst estimates are coming from. But when it comes strictly to like the valuation ratios, we were talking about like a 20 times price to operating cash flow for Alphabet, Google, 19 times for Amazon when I did my video on Amazon, and the price to operating cash flow for Baba is barely over 6. So buying, and it could be, assuming things play out right, that dropping some money on Alibaba and buying it here might be similar to buying Amazon for 75 or 80 bucks a couple years ago in terms of how it plays out over the next couple years. But first things first, you would have to actually get past the idea that basically you have, no rights, or that the shares are worthless, to be able to even get around to making the decision to buy it in the first place. And so we come to the DCF, which this is why it's almost borderline ridiculous if there isn't some major rug pull for ADR shareholders. We have a 10% discount rate. Okay. I think I could have done it up to 11 or maybe even 12 and still had the other numbers the same and have it still be around today's stock price. But just to get, a projected 10% annualized return on the cash flow, one, you can basically zero out their balance sheet like there's nothing on it, no assets. They actually have tangible book value of close to $40 per share, including over $78 billion in cash, US dollars equivalent in cash and short-term investments, which is like 50% of their market cap just in cash and short-term investments. So yeah, they have a tremendous amount of tangible book value, big war chest. The actual business itself has a very low chance of going to zero. It's more about, are the ADRs actually a fair representation of ownership? Okay. So, but we don't even give them credit for the balance sheet, right? We count that at zero. We give them zero growth for both growth stage and terminal stage. So basically 20 years of no growth, 10% discount rate, match the last 12 months of free cash flow for the next 20 years. And you would technically be looking at a 10% return according to the model. That is how ridiculously undervalued Alibaba is. Of course, there is projected growth coming on the earnings in the next year. Well, even sooner. 2024 is projected to be better in terms of EPS than 2020, which was a high both for free cash flow and EPS. So there you go. They don't have to do much to justify today's price other than not basically completely rip off all ADR shareholders. So given that, and given the fact that at least some what I would say are very well-informed managers of money seem to think that that's not likely, or seemed to in the past when they were alive think that that's not likely, I'm willing to hang on at these prices for now and maybe see if whatever Burry's thesis is happens to play out anytime in the near future. If you have Alibaba stock in your portfolio, please let me know in the comments below. If you think that it's going to be bad news for all American shareholders, let me know that too. Take it easy, everyone. Also, don't forget to subscribe to the channel for more videos. Make sure you like it for the algo. Catch me on Twitter or X, whatever you want to call it, at Mr. Macho Mog. We do money and manliness, investing, and all of that good stuff. Make sure that you give me a follow. That one's important. Make sure you go to Discord, link in the description, and catch me every Saturday, 8 p.m. Eastern, Cashflow Kings Live. Also, feel free to be a channel member if you want to support me directly. Have a wonderful day, everybody.